we are doing presentation 4 of 5. So I'm hoping that you've joined us along the way for all the presentations. If you haven't, they've all been saved on the 6 websites, so you can review them all. Last week, what we talked about was basically, it was an education session talking about passive real estate investing and talking about the different types like REITs, mixed equities, and mortgage funds. And RealAlt is a mortgage fund. We provided 10 questions you should ask if you're looking to invest in passive real estate. And we responded to those questions about our Series A. So today, I thought we'd bring in more experts on our team. And so who we have here with us is Rick Plati, who's our Executive Vice President of Sales for Dorr Capital. Judy Wong, who's our Executive Vice President of Underwriting and Loan Servicing. And don't worry, she'll explain what that is in a minute. And then we have Harshil Mereiya, who is our Director of Investor Relations. And I referred to Harshil last week when we were talking. So hopefully you have lots of questions for him. So on that note, you had a lot of questions last week, which was amazing. I think we were able to answer most of them, but we also saved some of them for today's question and answer period. So please feel free to fire off those questions in the chat box, and we'll get to those in a few minutes. So I do have a few questions that I've started for the team to help you get to know who they are and what they do. So Rick,
yes.
We invest in mortgages. So how do you pick the developers or choose the developers we're going to work with?
So we look at track record. Track record is the most important thing for us when looking at potential new clients. We want to know sort of who they are, what they've done, how long they've been in business for, their reputation in the marketplace amongst purchasers, other lenders, and trades in particular. So that would be the most like the criterion of really looking for a new client.
So are you dealing with clients like Riocan or Menkes or the large one?
I wish we were dealing with those guys. See, when people talk about financing, you have sort of different layers of different types of lenders. Those types of clientele would be dealing with the banks, the top 5. What we're looking for is the medium to sub-large scale developer. The barriers of entry getting into real estate is quite high, and the project costs are becoming it's expensive to finance. So we're looking for guys that, again, have more of the execution track record, but don't have that financial wherewithal to get to that next level. And that's what we're sort of concentrating on.
Okay, I see. And so the developers you're looking for, because I've previously told the audience that we're looking for developers that are buying land and they're going to be constructing new homes, right? So we're targeting that specific developer versus retirement home developers, right?
Yeah, so I think the asset classes that RealAlt takes bits and pieces of mortgages would be, like you said, land development, which is putting pipes and hydro into the ground, housing construction, inventory loans. So inventory loans are completed units, either low-rise or high-rise. And those would be the segments of types of mortgages that we would be investing in.
Okay, and so you've talked about the top 5 banks. Why wouldn't these developers just go to their, local TD Canada Trust or CIBC?
So the 5 banks they have, so they deal with the billionaires that we have in our current marketplace. So there's really, really, really large developers, Menkes and RealCan being one of them. And they prefer to stick to those particular groups. Okay, the reason why is because over the years, the banks have been ratcheting down their exposures to real estate. So where 10, 15 years ago, they would lend on 75% of cost, today they're doing 65% of cost. And not every developer can do that, okay? So that gap has created funds like ourselves to fill that gap. So again, so people that are again, medium tier to that A minus tier in terms of financial wherewithal, they can't meet those thresholds for the bank. So we can fill those. And there's a whole subcategory of banks outside the top 5 as well. Banks, National, Laurentian, that take a little bit of extra risk in terms of loan to value and not that higher of a price. So there's different barometers or different segues of what the banks can fund. And then again, RealAlt takes a piece of each of those deals moving forward. So. Okay,
great. And can you give us a specific example of a developer and why you work with this particular developer?
So one that comes to mind would be Fure Homes from the Southwestern Ontario. They are the oldest home building company in Ontario. I think were created in 1954. The founder is still active in the development in his mid-90s. Mid-90s, Harold. Again, we were attracted to them first and foremost. Execution track record. They've been around since 1954. They have a great reputation amongst homeowners. They've built a lot of homes. What happened in that particular instance is they needed their financing was lopsided, where they had more of their expensive financing took up more of the stack versus their cheaper financing was less of the stack. And we really transformed them into a company where they are today, which is the opposite. So they have their largest part of the stack is their cheapest debt, and very little is their most expensive debt. So those, again, first and foremost, would be execution track record and reputation. And we've been dealing with them now for just over 10 years now. So we have great success with Fure.
Great. Thank you. Okay, Judy, can you please explain what underwriting is and what your department does?
Sure. Underwriting is an in-depth analysis that we conduct on every project that we come across. Essentially, there are key factors that we would consider, and using those key factors, we would then determine whether this particular project is feasible and viable for RealAlt and in our portfolio.
Ooh, so can you elaborate? What are some of those key factors that you look at to assess if it's a good risk or not a good risk?
Sure. Location being one of the top ones. Although our preference is GTA and the Southwestern Ontario, we are definitely open to exploring other locations. In fact, we're looking at projects right now in Ottawa, Alberta, and even out in New Brunswick. So we're definitely open to options, though our preference is the GTA and Southwestern Ontario. We would also look at market research. We would do a pretty comprehensive analysis. We would use that information to assess and conduct an internal valuation of the site. Not only do we conduct an internal valuation, we also rely on third parties like an appraiser to provide their assessment. We will look at a budget. As we mentioned earlier, a lot of our projects are construction. So if they're building single family homes, for example, we want to understand what their hard costs are, soft costs are. If they are doing in the near future or sometime down the road, we want to make sure that they've accounted for any cost escalations. We would do sensitivity analysis on both the cost side and the revenue side, just to make sure that the project ultimately is profitable. Again, we also rely on third-party consultants like a cost consultant to walk with the borrower, and they review contracts and everything. So they would report to us and we rely on those numbers. In addition to what I've just indicated, we also look at the site. We want to make sure that the site is suitable for the development. So we would look at soils report, environmental reports, just to make sure that there are no contaminations. And all in all, we would use all this information. We would conduct loan to values. We want to make sure that the projects are profitable. We want to make sure that they're situated in a great location. And ultimately, we also look at borrower that Rick had touched upon. We want to make sure that these people can carry out the project. They have the financial means to carry out the project, their creditworthiness. And after this assessment, we generally have a pretty good understanding as to whether it's suitable for our portfolio and whether this would be a good fit for RealAlt.
Wow. Every time I hear the list, it's still mind-boggling, all the analysis that we do, which is great because we're trying to invest, we're trying to protect ourselves as well as our investors, which is amazing. So on that note, how many deals have you underwritten and do they all get approved in a year?
In the past year, we've come across about 100 deals, but we've only funded and closed about 30 of them. So you can see that we come across a lot of things, and we would look at all the different factors that I just highlighted earlier. And depending on those elements, we would then decide whether it's something we choose to proceed. So you can tell that we don't, move on with every deal that comes across our plate. So.
Wow. Yeah. So you must have a whole team of people that are doing tons of work for you. Can you share anything about your team or some interesting facts about the team?
Yes, I have a super, super smart team. They love numbers. They are all by trade or they've graduated some form of engineering degree. I think we got a civil engineer, we got a rocket scientist engineer, and they all love numbers. They love to dive deep. They love to do their research, and they've been doing a great job. So.
And they're smarter than we are.
Yes, they're definitely smarter than we are.
Just to let you and Rick know, we're getting flooded with questions in the chat, so we're going to come back to you in a minute because people are asking all sorts of great questions. Okay, so stay tuned. Okay, but let's get Harshil involved as well too. So Harshil, what type of questions do you get asked most often by investors?
So it depends on where investor is in their investment knowledge journey. So there are some investors who have been exposed to the real estate sector and they know because they have been like a property manager or they have been in the construction sector. And they have seen how the industry works. I call them racehorse jockeys. So they kind of know what they are into and they ride that. Their questions typically are like, where are you developing? Where the projects are coming from? What's the scope of the projects that you are underwriting now? Where the markets are? So think about this. This seasoned investors. Their mindset is like, even when they are driving on the road, they are looking at something coming up in construction. They look at, what's going on in this area? What's happening over here? So that's their mindset. They are always looking at what's developing in their community. And that tangible thing, like how my community is developing, is what drives them. On the other spectrum, we have a new investors who are kind of missing out on the true diversification. Because if you look at it, mostly mainstream funding has been about stocks and bonds, and recently people have kind of realizing that they are not investing into the aspects of real estate per se, and average person spends about 30 to 40% in their house mortgage and stuff. So if that's not part of your investment, probably you're missing out on that investment opportunity as well. So people looking for diversification, they look at how the fund is structured, how they can put it in their different accounts, and how that will impact on their investments in different ways. Over the last 2.5 years since we introduced the fund, we have put all these details on our blogs, on our website, and we provide regular updates. So just sign up for that, and you will also keep updated on the knowledge that we provide on a regular basis.
Oh, wow. Okay, thank you. I think you partially answered my next question, but I just want you to clarify that one of the questions from last week was how much of a person's total portfolio should they invest in a passive real estate investment?
Well, that would depend on that person's circumstances, and he need to talk to his dealing representative, which I am also a dealing representative. So you can ask the question, and based on your investor's specific personal and financial circumstances, you can determine I would go to say, to answer the questions, like up to 30% is a sustainable, because that's what average Canadian would spend on their house mortgage. So if you look at the long term, if that much diversification you are looking for, that would be reasonable amount to spend on that particular investment.
So 30% is usually our max, right? We tend to redirect if it's above that rate. We'll definitely have a long
correct. So some investors, if they qualify at certain threshold above, they are exempt from that and they can go. So there are different criteria, but the investors are typically best suited to ask their dealing representative where they fit in.
Okay, thanks. And have you ever told an investor not to invest?
Yes, we do. So it depends on, again, your circumstances. So typically I see a lot that people do that from the reference. So I have a friend who is investing and all he does is real estate and he's doing great, but that friend might have 10 million while you are at 1 million. So you are not in the same situation. So although he can, maybe you should not. So there has been time when investors come to me and it's like, oh, I have 1 million and I want to put all of them in real estate, and I have to say, no, you can't. We can only accept up to 30% of your net assets. So we can accept like a 300, but not a million. So it does happen.
Okay, good. Thank you. All right, so question to, I think, everybody. Well, maybe I'll start with Judy and Rick. What are the main differences between Series A, our RealAlt Series A, and Series M? And can you explain it to people, please?
The main difference is Series A is loans. Okay, so we invest in pieces of larger loans. Let that be, like I said, land development, construction, or inventory loans. So we look at it from a lending lens. Okay, Series M is an equity, essentially an equity lens. So you're really an owner. Okay, so the metrics are relatively the same from a lending point of view to an ownership point of view. But to the point that we were talking about yesterday is when you're looking at it from an ownership perspective, you do a lot of the upfront legwork. Okay, so there's a lot of due diligence ahead of time that looks into the walkability score, the transit score. Those things are in terms of how far is the asset from amenities. In a walking distance, how far are you away from public transit? You're doing, again, same type of work in terms of the soils, environmental. Those are important pieces. You're really looking at the soils to see what type of soil it is. Is it impacted? Is it not? Is it suitable to build foundations on, and so forth? And what does it look like to get rid of it if there is topsoil there? So it's the metrics. Pretty much are the same, with the exception of we look at IRR, internal rate of return, from the investor standpoint. So when does the equity go in the project and when it comes out? The other metric is return on equity, which again we look at from a lending point of view, but really don't pay attention to it because it's not our metric. But on the borrowings, on the ownership side, it is an important metric. So again, we look at all the same things. It's just we look at it a little bit more in terms of metrics on the borrowing, on the ownership side, as well as a lot of that upfront work we have to do on the ownership side, whereas on the lending side, it's already done for us by the time that we start looking at the file.
And to add to Rick's point, from the investor perspective, so if you are looking for regular income out of your investment, then you are looking for Series A, which gives you monthly distribution, and that's as interest income becomes your annual taxable interest income. And if you're looking for a long-term capital gains and not intermediate, then you're looking for M Series, which has a higher potential upside than Series A, higher risk as well, higher potential return. So. But it's more stock capital gains, so that gives you a little different way of looking at the same investment in different form.
And I think for Series A, the debt side of things, the projects, the time horizon are usually 12 to 24 months. And as Harshil was saying, you get your monthly returns. But when you're looking at Series M, it is definitely the duration is much more longer. As Rick had mentioned, you're like the owner. So you're walking from the very onset and you got to walk to the very end before you, I guess, reap the benefits of it. So the time horizons are much extended. So it could be 3 to 5 or even to 7, depending on the nature of the project. So.
Okay. And why wasn't Series M launched sooner? Why wasn't it launched with Series A?
We made a conscious decision to focus on the debt fund first, because that's what we are. We're debt people. That's where we came from. So we wanted to get that off and running. And then once that was done, then we would focus on the M series. And then that's why we're here. And then given the environment that we're in as well, we think that there's definitely an upside to doing equity in the current marketplace. So that just expedited the starting this series sooner than later.
Okay. Okay, so Romeo, I think we're going to start to take some of the questions from the chat.
So repeat that again. Well, usually lending, the value is created through, like the borrower creates, the client or the borrower creates the value in the transaction, okay? In terms of you buy a raw piece of land that has no entitlements to it, then they do the work, municipal approvals, etc. That adds value to it. The process after that is they get sales, that adds value to it. And usually when you get the sales, that crystallizes the maximum value of that particular piece. So the lender doesn't provide the value, but we lend against the value. But ultimately, it's the market and the developer that creates the value in these assets.
I appreciate that. Thanks. Tony asks, and he notes that he's a construction lawyer in Ontario, but he asks 2 questions. One, what's an example of a mid-range developer in your view? And the second, this is, I think, to his expertise, does number of legal challenges impact your willingness to work with a developer?
So the second question is easy. The answer is yes, for sure. We do look at that. If someone is litigious, that speaks really, if it's multiple, that speaks, I think, to me personally, against their reputation. So we do look at that. And then to your first question, what's a medium-sized builder? I would say we would look at, on the low-rise side, anything 10 units. That's still small. 10 units. A medium size, I would think, would do probably 30 to 50 low-rise a year. If I'm transitioning to mid-rise, I'd say mid-size would probably be doing 1 or 2 projects at 80 units to 100 units each, in that sort of, terms of that snack. And I think there's a lot of borrowers that fit that model right now.
I appreciate that. Sravinder asks, and this is looking into the crystal ball a little bit, so feel free to answer just to the best of your abilities. But he asks if the market slows down in Ontario, and says it looks like it might. Which of your investment vehicles will become the most secure?
The most, it's a good one. I still think land, in terms of the RealAlt investing in land, because if our terms for land are usually, I would say, closer to 24 months. Okay, so a lot of this noise that we're experiencing in the marketplace should reside within those 24 months. 2025 is where all the people are talking about sort of construction is going to ramp up. So any land loan that you have now that's going through the planning progressions, I think is relatively safe.
Great, thanks. Steve asks, and this is when you're talking about your priority being the GTA, despite moving elsewhere. And he notes the GTA is quite large, and he wants to know which regions within the city are you focused on. Then as a second question, by Southwest Ontario, do you mean London or Kitchener-Waterloo or both?
I would say for Southwestern Ontario, both, but we have a stronger viewpoint to the Kitchener-Waterloo area, for sure. We're a big fan. We've always been a big fan of that area. There's work there, so people don't need to they're not bedroom communities anymore. So that's why we've liked the Kitchener-Waterloo area for a long time. In terms of GTA, I would say again Milton to the west, north to Barrie, south to the lake, and east. We're looking at a deal in Belleville right now. Okay, now, that's not GTA proper, but if I had to say GTA proper, I'd say Oshawa. So that would be sort of our GTA.
That makes sense. Philip asks, and I can sort of tell this is probably a question from somebody in the mining universe. Would like to know how long is the environmental assessment process for major housing developments in Ontario?
Usually, well, I think he's talking about like EAs. And that's usually, those are longer durations. We normally have environmental assessment reports that are done relatively quickly. I would say.
Well, still a couple of months.
Still a couple of months, because you have to get the locates and so forth and drilling crews and that type of stuff. But I think it's a different process than what he's referring to. I know there's EAs that need to be done if there's a highway, for example, going through, and the government did I think, an EA process of maybe 5 years, but we're not, again, development is not, at least the deals that we're getting into that's way early on than what we normally get into. We like to get into deals that are 12 to 18 months from being shovel ready. So a lot of that work has been already done in the past.
Great, thank you. Next question, there's a political angle to it, but I'll try and get to the guts of the question, which is really if there is a change in government that comes with it, a change of policies, and those policies include a fast influx of new building projects in Ontario. He wants to know how that would impact Series M investments.
I think it would be a positive impact, just because there's going to be more people looking for capital to deploy. I think the last stat I read is that we're currently 150 houses short, 1.5 million, that we need housing supply. So if they want to fast track that plus the 500,000 in immigration that we're getting yearly here, then I think Series M would be a fantastic vehicle because there'd be more housing being built and they would need more equity to do it.
Makes sense. Another question from Tony. He asks, what prompts the move? This was, I believe, early in the presentation. What prompts the move to Ottawa and new jurisdictions? He notes the city council in some of those places perhaps is more unfriendly to development. He says maybe tougher even than Toronto.
I would say population really is the driving factor. Ottawa's got has some pros where it's it's a stable economic city, a lot of government jobs there. So if there's population going there or to Belleville, we've used the term before, drive to qualify, given that housing in the GTA is pretty expensive. So people are looking to jump in Greenbelt and to live in these areas. They're still serviced by some sort of public transit. The GO Station network is sort of reaching those areas as well. So, and then working from home. So again, not everybody's working downtown Toronto, so they don't need the car to commute. So really the areas that we're focusing on are population driven. And a lot of our construction loans are predicated on pre-sales. So if you have the pre-sales in hand, then that's a loan that we would strongly consider in doing.
Makes sense. I live in Ottawa. It's often a lot busier than people think it is.
It is. And funny enough, for Ottawa, you can't find a hotel room there. They
Nope.
just don't have enough hotels in Ottawa. And yeah, I found that very surprising.
Yeah, my friends who come to visit stay in the guest room now because the hotel's $500. That's not like it used to be.
Exactly. Yeah.
One question, and this is, I think, about the market broadly for real estate. It asks, are you finding that your typical investors are sitting on their money right now to try and find a general market bottom, or do you find people are just now going full tilt into real estate?
It's of the first opinion. So I think there's a lot of cash that's sitting on the sidelines to make a purchase. Everyone seems to think the bottom is going to be falling out. We haven't seen end pricing. There's been a slowdown on sales, yes, but there hasn't been so far a decrease in land pricing. So we haven't seen that. Guys that you're seeing now selling are, I don't want to kind of say forced to, but they almost are, because they're in a land loan. They have some sales. They're getting some traction. It's taking a little bit longer. I think the finance community is working in terms of different type of structures, so that we can start a little bit earlier without having a full pre-sale test in place, so that we can get going. So there is a few that are in that sort of that flux that want to get to a construction loan because they've already started selling. So we're seeing that, but there's definitely a slowdown in sales and people just sort of holding off to selling new units until the market comes back.
I appreciate that. And Warren, I'm just reading through the chat. I believe that answers your question too, but let me know if there's still something else that you'd like the team to cover. One question from B2, I noticed joined us last week as well. He asks, what's the average investment horizon for Series M?
I'd say 3 to 7 years. Closer to the end product. By the time you, like I said, there's a lot of legwork depending on the planning. I'd say for a condo project downtown Toronto, I'd say it's 7 to 10 years. Closer. So really depends on where you are in the municipal approval process. But I would say 3 on the very short side if it's approved, to 7 on the long side.
Appreciate that. And also in the chat, Philip says 3 to 5 years isn't long. I'm still young. That sounds like probably somebody else from mining. Appreciate it, Philip. One question before I shoot it back to Tracey, and I'll ask all three of you while I've got you here. What are you most excited about at RealAlt over the next quarter?
Harshil, you want to start? I'll go last because I've done all the talking so far.
So we are launching Series M, and we have already started seeing a response from investors who are current investors, and they have already understanding of the real estate market. So they are seeing that as a positive because, as you know, in the time of fear, be greedy. In the time of positive market, be fearful. So some of the investors who have been into real estate for a while, they kind of think that this is a kind of a time to get into the assets that are available in the market at the distressed prices. So we see that a lot of interest coming in, and so stay tuned. We will be updating you on the Series M soon.
I'm excited for some of the investors who have already participated and walked with us through Series A. And now they get an opportunity to continue to walk with us with a different product type, and they get to be the owners. And then they also get to reap better returns in a different type of product. So excited for them, excited that we're giving them opportunity to learn more about this product type. And hopefully through today, you've seen a bit of what the origination team looks like, the underwriting team and investment team. We're definitely here to serve you guys. So excited.
I think it's exciting. We'll start from Series A. I think that there's going to be, there's currently a cleansing in the market in terms of a lot of weaker borrowers are being sort of forced out, given where the interest rates are going. That allows us to work with better borrowers, better locations, and potentially better yields. So that speaks, that's all positive for Series A. And then for Series M, again, given the climate that we're in now, is that we're getting into the next evolution for RealAlt, which is in the equity environment. which again, it's a different type of mind frame, getting into equity. So a lot of people like it in terms of if you want to try to equate it to like a sports athlete type of mentality, that's sort of where the RealAlt comes in. So we'll be looking at, again, more opportunities with better players, better locations, and better returns. So.
I appreciate it. And Tracey, I'll ask you the same question before we send off for the day. Just what are you most excited about at RealAlt over the next couple of quarters?
I'm excited about the new series that we launched. A is doing really well, and now we have M. So we have these two different offerings. I think they're both interesting and unique. To Phil's point, you can stay in as long as you want in the investment. So don't worry, you don't have to be out in 3 to 5 years. We're going to be continuously adding projects to it. And so you'll continue to reap the benefits over the years. So yeah, just Series M.
Awesome. I think that's all the questions that we have today. But if you're like me and you come up with the perfect question 1 second after it closes, please feel free to reach out. We'll have the RealAlt team get back to you as soon as possible. But Tracey, Judy, Rick, Harshil, thank you so much for talking with us today, providing your insights and expertise. I appreciate it very much, and appreciate everybody who joined, particularly those who asked questions. With that, I'll hand it back to Tracey for a final word and then send off.
Thanks for joining us again today. We have one more presentation next week where Harshil is going to get into the details of the product. And Brian will be coming back on to also give you his perspective from a CEO perspective about the product. So thank you, and I hope to talk to you again next week. Have a nice day.
Thanks,
Thank you, everybody.
Thank
Thanks.
you.
Have a great day.